It's really quite fascinating, isn't it? How mutual funds have sort of become, well, central to how so many people think about finance now.
Absolutely. Whether you're saving for retirement way down the line or something sooner, they're often part of the plan, a real cornerstone.
Yeah, a cornerstone. And that's exactly why we wanted to do this deep dive today. We're looking at the latest trends, the vital stats, really, from the mutual fund world.
That's right. We've got this dashboard report. It's pretty recent, and it gives a fantastic snapshot, covers the global scene, but also zooms right into a key market in detail.
Exactly. So we've got global trends, we've got specifics on the U.S. market, and then a really granular look at the Indian mutual fund industry as of, what, April 2025?
Correct. April 2025 data for India.
Okay, so the mission here for you listening is to pull out the really crucial bits, the key insights, the standout numbers, so you get a clear picture of where things stand, without getting buried in spreadsheets.
Think of it as the highlights reel for the mutual fund market right now.
Perfect. So where do we start? Global view.
Yeah, let's zoom out first, get that global context. And, well, one thing that immediately stands out, looking at the data up to March 2025, is just how dominant the Americas still are in terms of total mutual fund assets worldwide.
Right. That's
Okay.
a huge chunk of the global pie still. Really shows the scale over there.
It does. Now, let's bring it a bit closer to home, maybe look at the U.S. specifically. The report shows some really substantial growth there over the last decade.
Substantial is right. More than doubled.
Yeah, assets have more than doubled in 10 years. That works out to about an 8% compound annual growth rate, which is pretty strong, sustained growth.
8% CAGR. Okay.
Yeah.
And that's across the board, like regular mutual funds, ETFs.
Pretty much, yeah. The growth comes from traditional mutual funds, exchange-traded funds, ETFs, and even those traditional closed-end funds. They've all, contributed to that overall expansion.
And drilling down into the U.S. market itself, what's holding the most assets? Still equities, I assume.
Oh, definitely. Equity funds are still the biggest players. They hold, 59% of the total assets under management, or AUM.
Almost 60%.
Okay.
And how does that break down? Is it mostly U.S. stocks?
Yeah, largely. So within that 59%, U.S. equity makes up 47% of the total AUM. Then you've got world equity at about 12%.
Okay.
After that, it's bond funds and money market funds. They're pretty much neck and neck, both around 18%. And then the rest, about 5%, is in hybrid funds, the mix of stocks and bonds and other sort of niche categories.
So equity's clearly leading, but here's something that really jumped out at me from the report. This massive shift towards passive investing in the U.S.
Ah, yes. That's a huge story, and it's happened remarkably quickly.
How quickly?
Well, as of 2025, passively managed funds, the ones just tracking an index like the S&P 500, they now hold 51% of the market share, the majority.
51%.
Yeah.
Just, wow, because what was it before?
Get this. Back in 2015, just 10 years earlier, passive was only about 24% of the market.
So it's more than doubled its share. That's a seismic shift, like you said.
It really is.
Okay, maybe let's just quickly clarify for everyone, active versus passive. So active management means?
Active means you've got a fund manager or a whole team making active calls, buying this stock, selling that bond, trying to, outperform the market index.
Trying to beat the average.
Exactly. Whereas passive funds, they're not trying to be clever. They just aim to replicate the performance of a specific index. Mirror the market, essentially.
Got it. So much less human decision-making involved day to day.
Precisely. And this huge swing suggests, well, maybe a lot of investors feel it's just really hard to consistently beat the market through active picking. And perhaps those lower-cost index trackers, well, they offer pretty good value over the long run. Plus, you know exactly what you own.
Transparency, yeah. Makes sense. Okay, so that's the U.S. picture. Now let's pivot. Let's dive into the Indian mutual fund industry. The report data here is up to April 2025, right?
Correct. April 2025. And the picture here is one of really impressive growth, quite dynamic.
How impressive are we talking? What's the overall size now?
The total industry AUM, it's hit an all-time high. Of course, 70 lakh crore.
70 lakh crore. That's
yeah.
a huge number.
It is. And look at the growth rate. Year over year, it's up 22.2%.
22% in 1 year.
Yeah. And even looking longer term, the compound annual growth rate is strong. 24% over the last 5 years and about 19% over the last 10. It shows real sustained momentum.
And I saw something about the milestones, like how quickly they're hitting each next level of assets.
Yes, exactly. The report tracks the time taken to reach each incremental INR 5 lakh crore. And, well, the time intervals are getting shorter. It suggests the pace of growth itself is actually picking up steam.
Interesting. So the curve is getting steeper.
You could say that, yeah. More money flowing in faster.
Speaking of money flowing in,
Yeah.
SIPs, systematic investment plans, that number seems huge too.
Oh, it's massive. Monthly SIP flows hit a new record in April 2025. Ours, 26,632 crore.
26,000 crore in 1 month.
In 1 month. And that's up 31% compared to the year before.
A 31% jump. Wow, that really shows retail participation, doesn't it?
Absolutely. It's a key indicator of individual investor confidence and discipline. And, the total number of SIP accounts is climbing too. It's at 8.89 crore now.
Almost 9 crore accounts.
Yeah. And the total assets held through SIPs, that's reached Rs 13.90 lakh crore. Even the average ticket size per SIP has nudged up a bit to just under Rs 3,000 a month.
So people are sticking with it and maybe even increasing their contributions slightly. That regular small investment strategy is clearly very popular in India.
It seems to be deeply embedded now, and similar to the U.S., equity funds are dominant here too.
Right. What's the percentage in India?
Equity-oriented AUM stands at Rs 50.18 lakh crore. That makes up about 59.9%, let's call it 60% of the total industry assets.
So a very similar proportion to the U.S., actually.
Very similar. And these equity funds have seen pretty significant net inflows over the past year. About Rs 5.56 lakh crore flowed in net.
Meaning more money coming in than going out? Shows strong appetite for equities? And it's not just the money, it's a number of people, right? How many investors are we talking about now in India?
The total investor count reached 5.46 crore in April 2025.
5.5 crore.
Yeah. And get this, 93 lakh of those were new investors who joined just in the last 12 months.
Nearly 10 million new investors in a year. That's a huge expansion of the base.
It really underscores how mutual funds are reaching more and more people across India. It's quite something.
Okay, so let's talk about that passive versus active trend we saw in the U.S. How's that playing out in India? Is it a similar story?
Well, yes and no. Passive AUM in India has also hit a record high Rs 11.67 lakh crore, and it grew nearly 24% year over year, so strong growth there too.
Okay, 24% growth. But what about its share of the total market? Is it near that 51% we saw in the U.S.?
No, not yet. The share of passive assets in India has been climbing steadily, but it's gone from about 10% in April 2021 to 17% in April 2025.
17%. Okay, so definite trend, it's growing, but still a much smaller slice of the overall pie compared to the U.S.
Exactly. The shift is happening, but active management still holds a much larger share in India currently.
Interesting. Does it vary by asset class?
Yeah.
Is passive more popular for stocks or bonds?
It does vary. If you look at funds investing in Indian stocks, domestic equity, about 22% of the AUM is now in passive strategies.
Okay, higher than the overall average.
Right. For debt funds, it's lower, around 10%. But interestingly, for funds investing internationally, passive makes up a surprisingly high 59%.
59% for international. That's fascinating. So Indian investors prefer passive ways to get international exposure, it seems.
It certainly looks that way from the data. Maybe simpler, cheaper access.
And within that overall passive AUM in India, what's the main type? Is it mostly equity index funds?
Yes, predominantly equity. Equity-focused passive funds make up about 73% of the total passive AUM.
Okay.
And digging into that, the majority, about 84% of that equity passive money, is in equity ETFs, those exchange-traded funds. The rest is in more traditional index funds.
And on the debt side of passive?
There, it's mainly things like target maturity index funds, holding bonds that mature around a specific date, and debt ETFs.
Got it. The report also mentioned something about SIPs feeding into equity funds more.
Yes, it highlights that SIP flows are forming an increasing percentage of the total gross sales, the total money coming into equity funds, which makes sense given the SIP growth we discussed.
Right.
And another remarkable stat, net sales for equity funds. So inflows minus outflows have been positive for 50 months straight. 50
months. That's over 4 years of consistent net inflows into equities. Speaks volumes about investor sentiment.
It really does. Consistent confidence. And when new funds are launched, NFOs, new fund offers equity has been totally dominant. In the last year, 97% of money raised through NFOs went into equity funds.
Wow, almost everything. Okay, what are the different types of investors, domestic versus foreign?
That's an interesting dynamic. Over the last 12 months, the data shows domestic institutional investors, DIIs, which include mutual funds, insurance companies, etc., were net buyers. They put money in. Whereas foreign portfolio investors, FPIs, were actually net sellers. They took money out overall during that period.
So domestic money is increasingly supporting the market.
That's a key takeaway, yes.
Right.
It points towards a growing strength and maybe self-reliance in the Indian market. Domestic flows are becoming more influential.
Right. Very important point. Okay, let's dig into the who. Who are these investors in India? Individuals versus institutions.
So the split is about 60% individual investors. That includes retail and high net worth individuals, and 40% institutional investors.
60-40. So individuals hold the majority share. And what about investing directly versus through a distributor or advisor?
The share of direct AUM stands at 48%, so nearly half of the assets are invested without an intermediary.
Almost half. How does that break down between individuals and institutions going direct?
Well, about 16% of the total industry AUM comes from individuals investing directly, and about 31% comes from institutions investing directly.
Okay, so institutions are actually a bigger part of that direct channel overall.
Correct. But a significant chunk of individual money is also going direct now.
And where are these investors located? Is it still all concentrated in the big cities?
That's changing quite significantly. The report shows the share of assets coming from what they call B15 cities, basically, cities beyond the top 15 metros, has risen quite a bit. It was 25% back in March 2020, and now it's up to 35% as of March 2025.
From a quarter to over a third in 5 years. That's a real broadening out geographically.
It really is. It shows mutual funds are reaching deeper into the country. And what's more, the growth rate of assets in the B30 cities is actually faster than in the T30, the top 30 cities.
So the smaller cities and towns are adopting mutual funds at a faster pace now.
That's what the data suggests, yes. Strong growth beyond the traditional hubs. The report even calls out Telangana and Haryana as states with particularly strong AUM growth.
Interesting. Wonder what's driving it there specifically. Okay, what about how different investor types allocate their money? Do individuals and institutions invest differently?
Oh, quite differently. Individual investors heavily favor equity. A huge 88% of their mutual fund money is in equity-oriented schemes.
88%.
Yeah.
Very focused on growth, clearly.
Yes. Institutions, on the other hand, have a much larger slice in liquid and money market funds, those very short-term, safer options, and also in debt funds and things like ETFs and fund of funds. More diversified, perhaps more focused on liquidity or specific mandates.
Makes sense. And looking at the overall AUM by category, retail and H&Is are the biggest group overall, but for specific things like debt funds.
For debt funds, yeah, corporate investors hold the lion's share. It really highlights how different groups use mutual funds for different needs. Corporates might use debt or liquid funds for treasury management, for example.
Right. Now, you mentioned individuals are 60% of the AUM. Has their share grown over time?
Significantly. What's really striking is that over the past 10 years, the AUM held by individual investors has grown about 8 times over.
8-fold.
Yeah, and that's actually faster than the overall industry growth, which is about 6 times over the same period.
So the retail and H&I segment is actually growing faster than the institutional side.
That's what the trend indicates. Underscores just how important the individual investor has become in India.
And we know they favor equities. 86% of their assets are in equity schemes, you said.
88% actually in the detailed breakdown for individuals specifically, but yes, overwhelmingly equity, whereas institutions, as we noted, are more spread out across liquid, debt, and ETFs, FFs.
Got it. What about that direct versus distributor channel again? Does that vary by fund type too?
Yes. A larger chunk of the assets in liquid money market funds and debt funds tends to be held directly. Equity funds still see a bit more flowing through distributors, but the direct trend is gaining ground everywhere.
Okay. And one last couple of points from the dashboard. Market concentration. Is it just a few big players?
Well, the report notes that the market share of the AMCs, the fund companies, beyond the top 10 is actually growing steadily.
So more competition, maybe more choice for investors.
That seems to be the trend, yeah. Less concentration at the very top over time.
And finally, any specific fund categories that stood out in terms of recent flows? Winners and losers in the last year?
Sure. In terms of net sales over the last 12 months, the categories attracting the most net inflows were sectoral thematic funds.
Yeah.
Focusing on specific sectors like tech or infrastructure, and arbitrage funds, which play on price differences.
Okay. Thematic and arbitrage hot. Any areas seeing outflows?
Yes, some categories saw net outflows, notably ELSS funds, the tax-saving equity funds, saw some money leave, net-net. Also, credit risk debt funds and, interestingly, gilt funds with a specific 10-year constant duration.
Interesting specific outflows there. Gives a feel for current sentiment shifts.
Exactly. It's a useful snapshot of where money is moving right now.
Okay, wow. That was a really comprehensive dive.
Yeah.
So if we try and bring it all together,
hmm
what are the main headlines?
I'd say, first, really robust growth overall, especially highlighted in the Indian market, hitting that 70 lakh core mark. Second, the clear rise and increasing importance of the individual investor.
Yeah, definitely. And linked to that, the huge popularity of SIP. That regular investing habit seems really ingrained now, particularly in India.
Absolutely. Then there's the passive investing trend, dominant in the US now, and definitely growing significantly in India, even if it's starting from a lower base.
Right. And finally, that geographical spread, mutual funds reaching beyond the biggest cities into smaller towns and regions, that feels like a major long-term development.
Couldn't agree more. So, considering all these trends, the growth, the retail surge, SIPs, passive, the geographic shift, it kind of prompts a final thought, doesn't it?
Go on.
Well, it makes you wonder, what's the next phase? Given all this momentum, how might the mutual fund industry evolve from here? And perhaps more importantly for you listening, what new opportunities or maybe even challenges might pop up for investors as these trends keep playing out?
That's a great question to leave people with. Thinking about your own strategy in light of where the whole industry seems to be heading, definitely food for thought.